Good afternoon, everyone. I am Sir Chitani, the moderator of this webinar. We are delighted to welcome you all to this webinar, which is being organized by Continuing Professional Education Committee of ICAI. And we are pleased to announce that we will be organizing this webinar series on every Friday. So please block your calendars on every Friday to get insights into various emerging and high value technical topics. It is my pleasure to be a moderator for the webinar on Beyond Compliance, Best Financial and Non-Financial Reporting Practices, followed by Bank Audit, Planning and Audit of Advances. In a short while, we will start this webinar. First, I would like to appraise you about the CPE Committee of ICAI. In today's ever changing professional scenario worldwide, the biggest challenge the professional face is how to stay on top of their game while adapting to new requirements and norms. Therefore, it is imperative to aim to be up to date, to offer unique guidance, influence others with their innovative approach and expertise. It is also vital to stretch old ideas beyond traditional boundaries to create new perspectives. In this context, continuing professional education facilitates professionals to maintain, improve, and broaden their knowledge, skills, and expertise required to achieve their professional goals through webinars, seminars, etc. There's a special note that CPE committee requests all the participants in completing a small feedback form to provide your valuable inputs on CPE guidelines and mechanism. And the same can be found on the CPE committee page of icai.org under the What's New section and also on cpicai.org. The program for this evening is as follows. We have two sessions of 1 hour each, and the topics are Beyond Compliance, Best Financial and Non-Financial Reporting Practices, followed by second session on Bank Audit, Planning and Audit of Advances. Our eminent speakers will talk about the above mentioned two emerging areas of professional interest. But as we move forward, we have the Vice Chairman and Chairman of the CPE Committee with us. Before I start and hand over to them for their welcome address, I would like to read out brief about them. So, the Vice Chairman of the CP Committee, C.A. Vishnu Kumar Agrawal, is a Central Council member of ICAI for the term 2025 to 29. He currently serves as the Vice Chairman of CPE Committee and the Direct Tax Committee of ICAI. Additionally, he is an esteemed member of several other key committees of ICAI. With over 2 decades of experience, he specializes in income tax matters and has also authored the book Landmark Judgments of Income Tax. Beyond his professional commitments, C.A. Vishnu Kumar Agrawal is actively involved in social service and community initiatives. His professional acumen, leadership roles, and dedication to both the profession and society make him a respected figure in the accounting and taxation domain. Sir, we welcome you for your welcome address on this session today.
Thank you, Rajatji. Honorable Central Council member and my elder brother, Satish Gupta Committee, our moderator of this particular session, Sri Rajat Chetani ji, Speaker, Sri Kuldeep Kothari ji and Ajay Kumar Atola ji, all my esteemed members of this webinar. Friends, month of the March, in the last week of the March, we all chartered accountant, we planning bank audit. From the first week of the April or second week of the April, we audit of the banks. But the lack of the time, we complete the 15 days. Friends, with the limited time period and the resources, we complete the bank audit within 10 to 15 days. So we have the expert knowledge. And today, our both of the speaker, Kuldeep ji and Ajay ji, will crystal clear about fundamental of the bank audit. Friends, we have again the limited time, and our chairman is with us, Sri Satish Kumar Gupta ji from Jaipur. He will also brief about our CP committee. Since I am a vice chairman, so I will not speak much more. Friend words, I will not stand between you and our speaker Kuldeep ji, Sis Gupta ji, and Matolia ji. Friends, with these, I welcome all of you. And our chairman's vision that every Friday we will do one webinar on each of the subject, and we will cover 365 days each and every week, 52 week subject. So around 104 subject we will cover in the next few months and the next year. With these words, once again, I thanks to each one of you. Thank you, friends.
Thank you so much, sir. Before I welcome our chairman, C. Satish Kumar Gupta, sir, let me introduce him to everyone who is out there. C. Satish Kumar Gupta ji is a Central Council member of ICAI for the term 2025 to 29 and has served as a CCM for the term 2019 to 22 earlier. He currently serves as the chairman of the CPE committee and has been the chairman of SMP committee of SAFA, South Asia Federation of Accountants, and CSR committee in the past. He has received several honorary awards such as Excellent Branch Award and Special Silver Shield Award during chairmanship of Jaipur branch, Best Member of the Year 2004 award, etc. He has written more than 8 papers and delivered lectures in different seminars, residential regional conferences, webinars on topics like GST provisions, income tax assessments, reassessment under Income Tax Act, and is a sought after speaker on matters related to income tax. Dearly. Sir, we welcome you all and request your address in this seminar for today.
Thank you, Rajat. Thank you. My brother, Central Council member, Vice Chairman of this committee, a very renowned practitioner of Mumbai, Maharashtra, belonging to Rajasthan, Vishnu Agrawal ji, and a very nice person, human being also. Speakers of this particular webinar, Kuldeep ji and Ajay Bhai, Tiwari ji, Secretary of the committee, and the team of the CP and technical team, and my dear members who are attending this webinar in a very large number. A very good afternoon or evening to each one of you. And let me welcome you in this webinar at the very outset. Friends, as you are aware that CP committee is organizing several programs physically, rather managing the entire CP credit network of our professional brothers throughout the country. And it's a very big task which this committee is doing, but together we are definitely working for this. And the biggest challenge we have this year is to implement the real-time attendance or real-time CP credit for our members. So we are working on that particular work very rigorously, and we hope that by the 2-3 months we will be able to bring a technology that will give us the credit only on the basis of real-time CP attendance. This is definitely a big decision for all of us, but to maintain the quality and to bring the maximum number to the program, we all are going for this particular decision, and we need your support. And we require your suggestions also that how we can implement this particular thing seamlessly and without giving a big problem to our members. So, and otherwise, friends, as far as Rajat informed, our Vice Chairman, Sir Vishnu Bhai informed that we are holding this seminar on Friday evening 4 to 6. Definitely, every Friday it will be held. But, friend, not only it is not restricted to Friday. Whenever we will come to know that any topic is important, anything which we should share with our members, we will come apart from the Friday also. That's in bank audit, we did it on uh, Wednesday, we did it on the Tuesday also. So we are open for any day, but the issue that apart from Friday, we would go only in the circumstances when we want to convey, we want to give some knowledge to our members on a very relevant topic or very important topic as of that time. So this is our commitment that at CP committee, you will never be disappointed as far as programs are concerned, as far as the speakers are concerned. We are working on the selection of speakers or resource persons also. We are making that on every topic we have some good speakers. So our branches or the CP chapters or circles may choose out of them on the topic of their choice. So these are the works which we are doing in the CP under the CP committee. We are also doing one more important program under CP committee this year. We are trying to reach out the remotest corner of the country. You know, friends, in some of the parts of the country, there is no CP program. The members have to come to another places by traveling even more than 1,000 kilometers, 800 kilometers, 500 kilometers, and they are even not in conversant with that particularly virtual programs also. So we are trying to reach out them, and definitely we would try this year. We reach at least to every part of the country and the remotest part of the country to make the CP workable for them. So with this frame, I don't want to take much of time, but speaking about two of the speakers, Kuldeep is wonderful. He's from Udaipur, and Ajay Bhai is from Jaipur. He belongs to SR Goyal and Company. If you remember Sunil Goyal sir, who had been our past president and of the institute, he is the partner in that particular firm, and he is a very good bank auditor. Bank auditor. He is presently CSA. I think by the presence of him, we would definitely gain several things to our knowledge today. So I would request best of luck to both of the speakers, and best of luck to the our attendees of the webinar, which I know that it has exceeded more than now. We are having more than 500 attendance in this program, and it will increase soon up to 1,000. So let us hope for good. Thank you very much. Thanks a lot. Jai Bharat, Jai ICI. All the best. Thank you very much. Over to Rajat.
Thank you. Thank you so much, sir. With more than 500 delegates waiting for the first technical session, let me just give you a brief profile about the first speaker for the session, CA Kuldeep Kothari ji. He is a practicing CA and is a co-founder of a limited company with over 13 years of experience and expertise in handling and advising listed entities in the field of FR framework, integrated and ESG reporting advisory, Ind AS, SEBI, LODR, and compliance review. He has co-authored books, publications on investor awareness and financial topics, compendium on case studies on excellence in financial reporting, commonly found errors in financial reporting. He has been a keynote speaker on various topics like financial reporting framework and practices, SEBI LODR, Ind AS, integrated and environmental social governance reporting framework, and is empaneled as a peer reviewer and technical reviewer. We welcome you, sir. Now, we request you to take over for the first session's deliberation. Over to
Thank
you,
you,
sir.
Rajat. Thank you for such a wonderful introduction. First of all, before I begin with the technical session formally, I would like to place my thanks towards the Vice Chair of the committee, CA Vishnu Agarwal sir, and the Chair of the committee, Satish Gupta sir, for giving me this opportunity to interact with all of you. And special thanks to all of the attendees first, that they have gathered in such a large number. Though we all understand that maximum of the practicing chartered accountants of the firms are busy at this point of time in planning and executing the bank audit. And while we were discussing what session or what topic to be conducted or taken up for this session, very rightly the leadership has suggested this topic, because not only this is a very important aspect of auditing, that the compliances related to Ind AS as well as the non-financial integrated or BRSR, etc., is important. It correlates with the current issue of bank audit also, because if you are auditing large advances branches in which the companies which are preparing balance sheets as per Ind AS, then it will be, I feel that it will be helpful for you to figure out the quality of reporting of those companies. My special thanks to the committee and the whole secretary of the committee as well as the team for smoothly coordinating all of these things. So without taking much of the time, because we are setting at I think 4:15, so I'll not take much of time in other formalities. We'll straightforward jump to the topic. Before formally we begin with discussing what is the best non-financial financial reporting practices. Let me give a brief background from where it is coming from. So see, we all are auditors by nature. We all are chartered accountants, and when we talk about compliance, there is a word which has been, Rajat, you will appreciate that the word which has been used very often in recent times, excellence. Everybody is talking about excellence. We talk about transparency, integrity, etc. But excellence is something which is an embedded feature or embedded, attribute of a chartered accountant. So there is a very thin line of difference between being compliant and doing something at excellent level or above par. That's what we will be discussing, because there may be, a disclosure. There are four aspects of an Indian accounting standards when you talk about disclosing the same: recognition, measurement, presentation, and disclosure. So we'll talk more about presentation and disclosure, because these are the areas which are, less spoken about. Then the second very important amendment which came last year, and I think companies are not doing it in the right way. And we, as a auditor also, and as an advisor also, we should have a look at the same. That is material accounting policies. It is very significant. This change was being implemented from last year only. Ind AS 1 was amended, and para 1117 of Ind AS was amended, and material accounting policy information concept was introduced. It is clear that amendment notification as well as standard also, that there should not be any obscuring information. There is a way out how in material accounting policy information is to be recognized and presented in financial statement. Then, so if you, like, we all deal into shares and securities, and as well as we in one or other area we are related to, like as a auditor or as advisor, we are connected to listed entities also. So when you see the annual report, you will see a significant difference from what it used to be in like 10 or 15 years back. It used to be in a plain piece of paper, black and white, print, only financial statements coming out in that report. And now you see exquisite looking, graphic driven, theme driven annual reports, including non-financial reporting part also. And you'll be surprised to know that almost 60 to 70% of the annual reports, portion is being covered by non-financial reporting also. Many global frameworks have emerged as such as integrated reporting. India has its own, standardized format of reporting ESG attributes, that is BRSR. It is a statutory compliance which every company has to do. They are falling within the top 1,000 companies list by market capitalization. So this is also a very important area, and I feel that rightly the leadership as well as the committee has chosen this topic, because see, when you talk about CP, it is it is about evolving each and every day and continuing updating your knowledge. So these are new fields in which I feel that there is a lot of opportunities for all of us as a chartered accountant also, be it as an advisor, be it as an auditor, be it an quality reviewer also. Because recently SEBI has clarified also, and they are coming out with an amendment that there will be a concept as it is there in the case of audit of listed entities, that is quality reviewer. There will be a concept of having a quality reviewer for the company also, and the responsibility of those who are sitting at the top of the organization, that is KMPs, CEOs, CFOs, is not limited to signing or giving in compliance certificate. It extends way beyond, and it is their duty, primary fiduciary duty, to ensure that whatever is being reported in the financial statement as well as other part of the annual reports or non-financial sections of that annual report, they are true, accurate, and they present in correct way. Neither there is any window dressing nor there is any greenwashing. So this is the very brief background what we will be discussing today. This topic specifically requires a lot of time, but I'll try to cut it down to 45 to 50 minutes, so that we can cover the most important or maximum of the same, and rest we can discuss if I'll get an other opportunity with the committee. So when you talk about excellence, there is a word which is associated with it, quality. And there is, in our institute also, Mother Institute ICI, there is in specific quality control mechanism which is there. I'll take a minute on that, so that we all are aware that if we are doing any audit, or if we are doing any work, then how we are governed and how the quality is being assured from the regulator side also, that is ICI. So there is quality review board, which we all know. relatively the work of QRB is more or less subsumed into in terms of large listed entities with NFRs, because the scope of TOs are slightly same. Then there is a board, FRRB, Financial Reporting and Review Board. It looks after financial statement, annual reports of listed as well as unlisted entities, and about the compliances and non-compliances of the reporting standards. Then there is peer review board, which ensures that the CA firm or the auditing firm which is doing the work is have adequate resources and the processes and systems are in place, and they are they are in kind of a way certified to do audit of listed entities. And then taxation audit quality review board. Maximum of thus, if we are working in like tier 2, tier 3 cities, this will be more relevant for us, because this board looks after the quality of tax audits and tax audit reports being submitted. It is also very important because see, there are 44 parameters in that tax audit form 3CD, and sadly or other way, hardly all points or all questions of that form 3CD is being looked after carefully, I would say. This is my personal experience. But after being associated with ICI Research Committee, CFMIP, CP, etc., SRSB, so the reason why I say that we should all come and join institute in and contribute in the manner which is possible, because it will help you in your own practice also. So if you talk about me 5 years back, you can say ki, in normal way we were doing audit assurance functions, etc. But if you ask me today in 2025 to sign any balance sheet of a private limited or limited entity also, I'll think twice or thrice about the same, because only due to the experience and exposure given by the Mother Institute, we have gained such knowledge, and the nitty-gritties of the small mistakes which can prove to be fatal at a later stage, if it is if you talk about auditor side. So there is a amount of balance which is required to be carried out. Like people talk about bank audit, limited time and execution of time, there will be immense amount of pressure on all of us if we are conducting bank audit, and there will be a pressure, like in some cases we get mail that you should start it by 4th or 3rd of April, and you are required to complete it by 10th or 12th of April or whatever it is. But it has been said by the leadership as well as in past also, there is no need, nobody can force us to complete or conduct the audit in a certain way. It was independent and it will be independent, and it is independent, but a due care should be taken care of, and that will be covered by my senior and the speaker of other session, Ajay sir, in the second part of this particular program, and he is the authority on this topic, so I will not take much time. So first we will discuss about non-compliances or pitfalls in Indian accounting standards and why it is related to best practices. Because see, if you talk about best practice, it becomes very subjective. But if you talk about pitfalls or common non-compliances, then automatically it translates into an excellence financial reporting practice, and eventually it will be called in best practice. These are the areas which somebody might say that they will not attract a huge penalty, etc., but they are equally important. Regulators are looking at it, and ICI is looking at it from quality controls perspective, and AFRA is looking at it, and other regulators, exchanges, SEBI is also looking at it. So when you talk about Ind AS 107, so we'll try to make this next 35-40 minutes interactive. I'll ask questions also, and if you have any questions, any of the participants, you can write it down in the chat box also. So if you talk about Ind AS 107, so it is related to disclosure of various type of risk and financial instruments, etc. So when you talk about market risk, can anybody tell that what type of market risks are there? So 107 prescribes that there has to be a mandatory disclosure of market risk, and there are 3 types of market risks which are there. I am continuing the session simultaneously. If you get any answer, Rajat, you can write it in the chat box, or you can ping in between also if there is any question. There are three type of market risk: currency risk, interest rate risk, and other price risk. And this other price risk is something which is most widely, market risk, which is not reported in the correct way. Either it is not reported, or either it is reported, but the terminology which is used is not correct. For an example, if you see in balance sheet of a listed entity, if you are auditors, then you will be very well aware. If you don't know that, you open an annual report and write control F and market risk. You'll see that in maximum of the reports, financial statement, you will see currency risk, you will see interest rate risk. But there is a third type of risk, which is other price risk, which includes equity risk. Means that if you have any type of equity investments, whether listed or not, and commodity price risk. So if your entity is into manufacturing sector and dealing into any type of manufacturing process of producing any product, then all the significant commodities which your company has identified to be material for your manufacturing process, if there is any fluctuation in price of those specific commodities, for example, if your entity is producing steel, say, so if the raw steel or whatever raw material is being used, or so if there is any fluctuation in the price of that particular raw material, what impact it is going to have on the profit and loss of the company, that is required to be disclosed. It is called sensitivity analysis. So disclosing market risk and sensitivity analysis will go hand in hand. The next common pitfall is related to disclosure of sensitivity analysis only. So if you disclose any type of risk, if you identify any type of risk, then it is compulsory that we need to disclose the sensitivity analysis also. There are few type of other non-compliances or maybe areas of improvements which can make our reporting beyond par. I can share with you also. So one is other prices. If I am disclosing equity prices, if the investment is into unlisted securities, then it becomes a challenge that how do I identify that what is the difference it is going to make, and how it is going to impact my profit and loss, and it is going to hit my bottom line. There is a specific methodology to check the same. Then there is currency risk. We have seen in some cases, you will see, and you can go and read 10 20 top companies annual reports. You will see that if, for example, my entity is into exports also, and I'm dealing with various countries. For example, AED, I'm dealing with United Arab Emirates. I'm dealing with US, that US dollars. Then I'm dealing with, say, Australian continent. If, say, European countries, then there will be GBP. So there, I've identified euro, US dollars, AED, or some other currency, or say yen as an significant currency, for which I have shown the outstanding, or outstanding receivables, payables, and what risk is there related to those particular currencies. What is net receivables, net payables, which are pending as on the last day of the financial year. Then the second requirement, which is there in para 40 of Ind AS 107, is that you need to disclose sensitivity analysis of each and every market risk. So what we have seen, and what is prevalent also, that generally they don't disclose the sensitivity analysis of all type of market, all type of currencies, say in case of currency risk. So what will happen, that out of these four currencies, you disclose the sensitivity analysis for only US dollars, say, and you don't give any qualitative disclosures also regarding the other currency, then it becomes a challenge. Why it becomes a challenge? Because once you identify any currency to be material enough to be classified and disclosed under this market risk, then it is mandatory that you disclose the sensitivity analysis of the same. Going forward, the next type of non-compliance is related to recognition of trade receivables. It has been very widely discussed in 2023 when the NAFRA's landmark judgment on PSP projects. You can write it down also. PSP project submitted, there is a landmark judgment of NFRA in which it discussed about the same also. That it is there. If you read 109 with Ind AS 115, it will be very clear that if the contract with customer, that is, we identify revenue from contract with customer, if it doesn't include any significant financing component as per paragraph 63 to 65 of Ind AS 115, then in that case, that initial recognition of a trade receivable has to be at the transaction price. Has to be at the transaction price. There is no other way which is allowed or permitted. It is there in para 5.5.1 of India's 109 also. So 115 has to be read in line with India's 109 and this NAFRA advisory also. And you will not believe that many of the top listed entities also, I cannot take the name, they were showing in their accounting policies that they were recognizing trade receivables at fair value. So when confronted or when we discussed like with one of our clients, then they said that nahi, we are doing it on the transaction price only. So this is why that amendment I talked about of material accounting policy becomes important, because it is very relevant that whatever you are giving in your material accounting policy information has to be in line with your company's business, has to be in line with the practical way which has been taken by your entity while recording, recognizing, measuring that particular transaction. And coming forward, the next type of non-compliance which commonly we have seen is disclosure of changes in liabilities. So when you see a statement of cash flows, when you see in statement of cash flows, you will see that in some cases there is an column or there is a table called net debt reconciliation. So why it is important? If there is any type of financing, if there is any type of cash outflow or inflow from financing activities, then as per para 44D of India 7, it is required that you disclose a net debt reconciliation in which a clear segregation of non-cash and cash changes. If somebody asks what is non-cash changes, it can be in case of right of use of asset also, because post introduction of 116, now we recognize if the lease is not a short-term lease or it is not falling in any practical exemption, then you have to recognize a right of use of asset and as well as a contractual liability also, that is to be written off as an interest liability throughout the period of lease. So in that case, it can be a non-cash changes. So this is very important. If there is any figure which is coming in the financial cash flow from financing activities, and there are changes in financial liabilities, etc., borrowing is there, then as an auditor, as an advisor, or maybe if I'm scrutinizing any limited company's balance sheet from bank audit's perspective, it is a red flag that this net debt reconciliation has to be there. It is mandatory as per para 44D of Index 7. Then in case of 116, this again, it is a very interesting Indian accounting standard. We all talk about right of use of assets. We all talk about lease liabilities, how it is to be disclosed in profit and loss account, balance sheet, cash flow statement, etc. But there are certain qualitative disclosures also which are required to be made in terms of the leasing activities, the nature, if there is any restraint on convents which are associated, the future cash outflow, etc. These qualitative disclosures are equally important as the right of use or the financial liability, interest liability, lease liability section is. Then it is related to Index 7 only. So when you talk about Index 7, why I'm starting with the basic, the most. So if somebody say that I'm preparing an Indian balance sheet as per Indian accounting standards, or if it is a small company also, even the turnover is like say 100 CR or 50 CR or 150, whatever it is, or in that case also these are the few disclosures will be applicable to almost every company. So when you talk prepare a statement of cash flows, not necessarily, not blanketly you can say or disclose each and every transaction on net of basis. There is an requirement or guidance which is given in paragraph 22 of Index 7, which says that if for example, if it is a short-term borrowing, then only it can be disclosed on net of basis. But then again, it says that the time period of the borrowing has to be less than 90 days or 3 months. Then only it will be categorized and it can be disclosed on net of basis. Otherwise, the proceeds or repayment of the borrowing has to be shown separately. It cannot be shown on net of basis. Then again, it is a very interesting observation. If I want some questions also on this, So when you talk about basic structure of financial statement, then there is balance sheet, profit and loss account, statement of cash flows, and statement of changes in equity, which is required to be prepared in line with the amended Schedule 3. There is a guidance note, detailed guidance note of ICI, which is there. And when we prepare any financial statement, then I would say that, see, people do benchmark, other things also, model financial statement of big fours, etc. But this has to be the Bible of the guidance note of Schedule 3 has to be the Bible to benchmark whether I am preparing, I am disclosing, classifying, or the format or the structure of my financial statement or notes to accounts are in line or are in order or not. So statement of changes in equity, this particular observation is there in compendium which was published last to last year with research committee, that was on commonly found errors only, sir. So it says that, so when you talk about equity share capital or other equity in statement of changes in equity, now you go to guidance note of amended Schedule 3 and you will see that there is a specific format. In terms of equity share capital, it requires you to show whether there is any changes in equity share capital due to prior period errors or restatement of balances. Restatement of balances can be, can happen if you are adopting or migrating to Indian accounting standards for the first time, or due to some other issues also, any retrospective changes which take place. And prior period errors is something which we all know. So even if it is nil, then the format says that it has to be disclosed. So you can take a liberty of providing a footnote below the statement of changes in equity that there are no such errors in financial equity share capital, which due to which there is any change. So you need to either integrate the same into the format because it is a statutory requirement, or you need to give in footnote. It looks very small, but when it will be under scrutiny by FRRB, QRB, NFRA, or other regulators, SEBI, etc., then it becomes a non-compliance of Indian accounting standards. And a non-compliance is non-compliance, small or big, whatever it is. Then the second non-compliance related to statement of changes in equity, which is not stated here, that there is a specific format that how many reserves or what type of reserves, see other reserves, retained earnings, securities premium, and one other type of reserves that can come on the face of statement of changes in equity, and it has to be shown horizontally and vertically also. And other comprehensive income, whether it can be restated or not, it has to be shown separately. So we will see many of the statement of changes in equity sources sections in which 5, 6, 7, 10 number of reserves are being shown on the face of the balance sheet. Statement of changes in equity, which is not correct and which is not in compliance with the format suggested by the regulator given in our guidance note. So this again looks. Somebody will say that how do I club these reserves? See, it can be referred to the detailed note, because for equity share capital as well as statement of changes in equity or whatever type of reserves you are disclosing, there has to be a detailed note which is given in notes to accounts. Mandatorily, it is required to be given. It can be referred. So coming here again, a very small point which is connected to this only. Para 73, you can write it down also, because it is very helpful when you prepare a financial statement from scratch or you audit or scrutinize the same. Para 73 of Ind AS 1 says that each and every substantial line item of balance sheet, profit and loss account, or statement of changes in equity, if there is a detailed note which is there in the notes accounts, has to be cross-referenced. If there is any detailed note, it has to be cross-referenced. So for example, you are giving equity share capital in note number 15. So you need to cross-refer it for the detailed disclosure to note numbers 15, 16, whatever the note number is. Otherwise, it will not look like a non-compliance from naked eyes, but it is a non-compliance of Indian accounting standard also. Then related party or loans under 186(4) of Companies Act, these have been the talk of town since past few years. There was a very significant change which has come in SEBI disclosures also related to related disclosure of related party transaction, and it gives a detailed disclaimer, detailed way out how a related party information should be presented to the audit committee, should be presented to the board of directors for shareholders for approval. And it has, not only it has increased the working or maybe the efforts which are required to prepare these notes or minimum information related to RPTs. But it has, it has been done in line to bring transparency also. So one of the common errors which we have highlighted, or which we have seen while evaluating these annual reports, or working with these large listed entities in past few years, is related to disclosure of 186(4) of Companies Act, in which again I would put emphasis on presentation and disclosure. You might have be on the other side, that I've disclosed what is the total outstanding from a related party. Say for subsidiary, I've given any loan to a subsidiary, X amount is outstanding as on 31st March 2025. Then you say that I have disclosed the interest charge also. Whether it will suffice the purpose, the answer is no. It has to be accompanied with the qualitative disclosure, that what is the purpose with which the loan is given, what is the rate of interest, if there is any security guarantee, etc. Any restraint or constraint which is there related to this particular transaction, then it has to be disclosed. And this is something, uh, figures we do disclose because we are very good in figures, but qualitative disclosures are at many places where we lack in terms of disclosure. I think this we can skip. This is not that much relevant and will not be there in the large companies which we will see. Then again, one very small, just say, if anybody is from 90s, you must have seen Shaktiman. So there is a word na choti mein agar moti baatein. So these are choti mein agar moti baatein only. So when you talk about investment property, there is no other way in that initial recognition can be done other than cost. So there is a clear guidance in paragraph 30 of Ind AS 40. It says that an investment property has to be recognized at cost model only, which is referred in paragraph 60. Even if the fair value is calculated for some other purposes, which are required or given under the particular standard or elsewhere in other accounting standards, or due to any other statutory compliance, then only that case also, for recognition and measurement purpose, it has to be done on cost basis only. There is no other way. So if somebody is saying that I'm starting my investment property at fair value, then it is a non-compliance. Vice versa, you will say that we were here to discuss the best practices. So my friends, these are the best practices only. So if you can eliminate these, or if you can identify these commonly found errors, or these errors which are not fairly visible, or which are not fairly reported also, and they require minute scrutinization, then automatically you will move towards an excellence. And excellence means that best practices in your financial as well as non-financial reporting. One small mistake which I was surprised to see when we saw the financial statement of many of the large listed entities, that when you I'm repeating the word, that if you want to benchmark the format, structure, classification of expenses, terminologies, etc., either you benchmark schedule 3 ICA's guidance note, or you benchmark the India's raw standard only, because the format or the structure is coming out from there only. So very small error when you prepare in property, plant and equipment schedule. Now gone the days when there has to be an error that I am writing property, plant and equipment in the PP note, and I'm writing fixed assets in cash statement of cash flows. I've seen it also, but so there has to be the correct terminology which is required to be used, which is gross carrying value and net carrying value. But at some places we have seen people are using cost gross block, net block. Companies are using cost as on 31st March, say 2025, and net carrying value vice versa. So these are small things which might, make us feel that they are not going to make much difference. But when put under scrutiny or under hammer, they are going to make a big difference. They are going to impact the quality of our audit as well as our advice also. Then a very important topic. So if you work with service industry, or if you work with any of the industry which has significant intangible assets, friends, can be generally we think that goodwill is an intangible asset, correct? But other than goodwill, brand name, because so we are living in an era where brand building is something which is coming out at top, and you see the era of startups, etc. Building your brand, reaching out to your potential customers, or reaching out to a large universe is something which is the first priority of each and every entity which is there in the market. So brand can be an intangible asset. Your marketing intangibles can be an intangible asset, like companies like Wipro and Infosys show their marketing intangibles as an material intangible asset. So India's 38 clearly says that when you prepare your accounting policy, material accounting policy, as well as when you disclose your notes to accounts, there are two things which are required to be done. One, your intangible asset has to be segregated between finite and indefinite. The word is finite and indefinite. So if you see anywhere infinite, then it is incorrect. There is nothing like infinite. Finite. If your intangible asset has a life which can be associated to it, put that life. Otherwise, it will be indefinite. For example, my brand can be an indefinite intangible. For example, long-term leases which extends beyond 99 or more than 99 years, uh, they can be an intangible asset with an indefinite life. For example, softwares or any type of tech which I've developed, or any type of system or technology patent, etc. I've taken. It can be an finite asset if it has a life associated with it. The other thing is that if you have classified it in the correct way, then it is required that you need to identify material intangible assets to your entity. Then in that case, you need to disclose along with the notes to that intangible asset what is the remaining useful life of those material intangible asset. Third, commonly found non-compliance or error or point of difference which we can make if we want to shift to best reporting practices can be can be that if when you disclose the notes on intangible assets, you will see that any intangible has to be segregated into 3 or 4 parts. One, it is if it is internally generated, then it has to be, if there is any addition I am talking about, then it has to be mentioned there. If it is acquired through a business combination, then it is required to be mentioned. If it is purchased from the market, that is acquired outside, then it is required to be mentioned. So these are the commonly found non-compliances or area of improvements which is there in case of disclosures related to Index 38. I'll not take credit risk here because we have discussed. This one thing I will take, and then we'll move on to practical examples of the companies, and I will ask questions according to you what is wrong in this particular disclosure. So it will be very interesting. So if the chair and the committee permits, I will like to, and other speaker Ajay sir permits, I'll like to take 5 to 7 minutes more because we have started late. I'll try to cover these snapshots of the company's real-time disclosures also. So it makes more sense and you can relate to what is happening in practical instances. So this is related to provision metrics. Again, it is coming out of 107, 109, as well as NAFRA's advisory, which was issued post PSP Project Limited's landmark judgment. It says that everybody knows, or maybe if you don't know, ECL is something which is very relevant for financial assets and all type of financial assets. For all type of financial assets, when I say, it includes your bank balances also, it includes mutual funds issued by even SBI also. It is clearly written in that order also. It says that irrespective of the fact that it is an instrument issued by a reputed bank or consortium of the banks, or it is, even if it is a bank balance also, you need to, there may be a case that you assess and the credit risk comes to be zero. There is no credit risk, but you cannot say that it is not required to be assessed. Second commonly found non-compliance is related to ECL of trade receivables. So for trade receivables, a specific treatment which is allowed, that you can follow the simplified approach, and rather than putting out your ECL, there are 3 bucket category. We'll discuss if we discuss 109 in detail, like less than 12 months, and then lifetime expected credit losses also. So in case of trade receivables, you are allowed to recognize or measure using simplified approach, and lifetime losses probability can be used. But when you will see the accounting policies, material accounting policies of these disclosures, you will see one line which is written: since we are adopting simplified approach, we are not required to track the changes in credit risk. This is completely incorrect. It is not a correct line. It is not a correct disclosures. In any case, if you are using lifetime ECL approach, or if you are using 12 months ECL approach, if you are using periodic assessments, etc., there cannot be a case that you are not assessing your credit risk at a regular interval, at least once in a year, that is at the end of the year. So this is not correct. Third is that when you disclose ECL, there has to be a provision matrix. It is in sample of provision matrix. We will show some provision metrics of, if the time permits, of other listed entities also. So it is the format which is being prescribed, or which is given as an example by NFR in its order. So ECL is nothing but it is first assessing the probability of default. Then, so we prepare aging as per the Schedule 3 format for trade receivables and payables. So you put maybe in that only in the same aging bracket only. Then you calculate the probability of default for each aging bracket, and then you need to show as it is being shown in the table. This table is called provision matrix. Companies do write, they do say that we are using in provision metrics, but it is, I'd say, in two or maximum 2 or 3 out of 10 cases, you will see provision metrics in their statement of their financial statement. Otherwise, it is missing. So you are making a contradictory claim that at one instance you are saying that I'm using provision metrics and I'm disclosing the same, but you will not be able to find the same in your financial statement. So in next 10 minutes, I'll take these practical snapshots of various top listed entities which we have, collected, or which we have tried to which we have tried to collect in a way that it depicts the incorrect practice. It depicts the mediocre practice, or it depicts, like I would say, substandard, because we are in bank audit time, so everybody will be thinking about standard, substandard, or doubtful, etc. So substandard practice, and then there can be a better or best practice also. So I'll take a pause of 30 seconds. My question to all of you is that what is wrong in this particular disclosure? It is there in your screen. If you feel that there is anything wrong in this particular disclosure, please write it in the chat box. It is very interesting. Very small non-compliance. But if you can spot it, then I think that you are halfway through in this journey. What is wrong in this? Or if somebody don't answer, then the ball will be in your park, Rajat.
Kuldeep sir, I'm waiting for participants' answers here. I've opened up the dialog box here. I'm just waiting for them to answer.
We'll wait 30 seconds, otherwise I'll answer, because otherwise we'll miss out on the other things also.
Sure, sir.
Do we have any answers, Rajat?
No, sir, not yet, sir.
You want to make any guess?
Just a sec, sir. If you're just telling me, I'll just make a guess here. Operating profit before working capital changes. Depreciation, finance cost, and dividend income. Doubtful and bad debts. Doubtful and bad debt advances, loans and deposits. Sir, I think this impairment of investment in joint venture and this doubtful and bad debts, advances, loans and deposits. These two components, they shouldn't be part of the cash flow from operating activity, although the adjustments, through adjustments, we are removing them. But sorry, sir, that's my only best guess.
So I'm sorry. According to us, this is not what the non-compliance is all about. It is on the top of this snapshot only, Rajat. So when you read the heading, it is written cash flow statement. So it is not cash flow statement. The standard says it is statement of cash flows. As small as that. And in past, I'll tell you, auditors were penalized for this small error. So somebody might say that, what does it make any difference? But when you, like it was there in one of the exchanges annual report also. So when we met them, we said, "Here, you are regulating the other entities. If somebody will download your annual report and they'll say ki they are also writing cash flow statement in 2024, will it make any sense?" So this is from a large listed entity, which is under top 100, and it has
Wow,
been
sir.
certified. Yeah.
I didn't expect it that it is coming from there.
It is very, it looks very minuscule, but like an offense is an offense and error is an error. Coming to the next disclosure, so this is again, I am giving you two three examples, not one example, that, and it is there in this year also, though these snapshots pertain to last year, but it is there in this year also, these errors. So it is again related to a very large entity which is in which is into home decor, paint, etc. It was their balance sheet. Now this is again very interesting. कई बार बोलते हैं ना कि घर के किसी एक हिस्से को या कोई एक पार्ट ऑफ अवर करिकुलम वी लीव इट कि ये कोई खास काम का नहीं है. So this India's is like that only. India's 105, that is assets held for sale. So what is wrong according to you in this particular India's disclosure which is there on the screen? If anybody can answer. If you don't have any answer, I'll not bother you, Rajat. I'll answer it on behalf of you and the committee. If there is any answer, then
Sir, I think there is some gap between the time we are discussing here and it's being played, telecasted online. So,
okay.
so maybe the responses will come with a gap of 1 to 2 minutes.
So
It's better if you take
yes,
up,
yes.
sir.
So I'll take up this. So when you talk about 105, Rajat, there is a very clear scope which is given in that particular index. It says that if the probability of sale, it is written in this particular disclosure also, that if the probability of the sale of a particular asset which is parked or categorized as asset held for sale is expected to be completed in next 12 months, then you can do this thing, and then you can declassify it, and then you can park it as under asset held for sale. But what if it doesn't happens in 12 months, which is the usual case which is there with the companies? And then in that case also there is appendix B1 of Index 105, which says that if the reasons are beyond your control, then you need to disclose those reasons. And if it is not beyond your control, then you reclassify it to its original group, and then whenever it is again being in the line to be sold, then you can reclassify it to asset held for sale. So what is wrong in this? You see the value of land remains to be same in 2 years, and it is not a 2 years case. You will see in 2024-25 also it will remain same. The value of building remains to be same, 11 crores and 10 crores. So if there is no change which has happened, so if something cannot be an asset which is classified as asset held for sale, say as on March 24 and March 25, it cannot be same. If something was classified as asset held for sale in 2024 and still it is not being sold, then in that case it has to be either explained if the reasons are beyond control of the company, or it has to be reclassified. Again, people will say ki it is not going to make much different perspective for the user's financial statement. But this is not as common non-compliance. This is I feel that it is a very severe non-compliance which is there. Then we talked about Rajat, expected credit loss, and I have disclosed and presented in sample format also. So whether this provision matrix format is correct or not, according to you, then I'll answer to fasten up the things.
Net outstanding percentage collection to gross outstanding in current year. Less than 25, more than 25. Allowance, loss allowance measured at lifetime expected credit loss.
So again, this is not correct,
This is-
because when we talk about ECL, the basic concept of ECL is that probability of default has to be calculated it is required to be shown in a table or whatever other format if you have any other format. This again makes an it is kind of a Microsoft, DOS or that kind of a prompt format. If it is greater than 365 days, then and the collections are less than 25%. If an two conditions which we used to do in our student times when we used to learn those coding languages, and that they say that yes, then that to the extent of lifetime expected credit losses, it is not correct. You need to show probability of default as well as specific ECL, that is expected credit loss, based on the aging of those trade receivables or other financial assets also. I'll skip this provision metrics things.
So I
This
think
is
the
again,
participants are not
yes, yes.
able to view the screen that you're sharing. Uh, can someone from the technical side help? Because I'm getting these questions in the window. The screen is not visible.
Are you able to see the screen, Rajat?
Yeah, I can see the screen, but when I'm seeing it on the ICI live TV, there is some glitch there. They are not able to see the screen.
So, Rajat, it is there on the screen. It pertains to Schedule 3. In 2021-22 was the first year when the amended Schedule 3 was introduced, and there was a lot of changes which was made in the format, as well as some extended disclosures were introduced. One such disclosure was related to if the title deeds of the property is not held in the name of company. So there are two type of disclosures which are there in an annual report. As a auditor also, I need to make this disclosure in the Caro report. So I certify or I take certification or based on the from the company, and based on that I give that Caro report. And on the other side, the companies are also required to show it as a note to their financial statement. Do you feel that what is there on the screen is correct? So I'll see, since we are having positive time, I'll answer it for you. You see, the reason for not being held in the name of company is pending litigation. So the guidance note of institute clearly says, the schedule 3 clearly says that if there is any property which is not held in the name of company, the title deed is not held in the name of company, then there has to be clear reason which is required to be given. Point number one. This is not clear reason. Point number two, if there is any delay which is attributable to any litigation, then the extent or exact state of that litigation is required to be given. It is not expected. Somebody might say ki there are 3, 4, 5 dates in case of property disputes in a year or maybe in 2 years, and whatever it is, and property disputes can go till eternity in the present judicial system. But there has to be an at least self-explanatory disclosure related to the stage of litigation which is required to be given. That was not there in that particular annual report. This is an example of statement of changes and equity error. I was mentioning that there is no such disclosure related to whether there is any change into equity share capital due to prior period error or restatement of balances. It is not there. It is of a listed entity only. Then you will see this statement of changes in equity. It says it has incorporated that prior period error as well as restatement uh, columns into the format only. Then again, what is incorrect? The thing which is incorrect is other equity. There cannot be 10, 11 reserves which can be shown. Securities premium, retained earning, capital reserve, and other reserves can only come on the face of the statement of changes in equity. It is there in guidance note which is issued by institute. Then again, it is related to other equity. Then it is related to credit risk. I think we have fairly covered the same. Then it is related to, we can take
Kuldeep sir,
this is, yes,
Kuldeep
yes.
sir. In the meanwhile, may I please ask you to request all the delegates
Hmm.
to post their questions now if
Yes,
they
yes,
have
yes.
regarding this session, so that
Hmm.
in the meanwhile,
Correct, correct.
when we get their questions, in the meanwhile, you can take up
Hmm.
those things. Yeah.
So we'll be winding up this first technical session in next 5 minutes. So if anybody has any questions related to whatever being discussed till now, or elsewise also related to any of the disclosure of any other index, or as well as non-financial reporting also, please write your questions in the chat box. there may be a lag of 30-40 seconds or a minute or so between when we are speaking and when it is relayed on the ICI TV, etc. But do write your questions in the chat box. Even if you are not able to write or pose your questions, you can share your questions post this session with the committee, and we'll be happy. We'll try our level best to answer your queries.
So we have one question here.
Yes, please.
From Sheila Ravishankar.
Please.
So they want to understand lease termination net.
Lease
What is
termination net, as
Yes,
in related to what?
as in maybe the disclosure for if there's a lease termination, how do we disclose that, or is there any
See,
specific thing that we need to mention?
specific thing again, as far as my knowledge is concerned, it is not required to be any. There is no specific format for this particular disclosure. It will fall under that para 59, if I'm not wrong, qualitative disclosure thing. That if there are any changes, restraints, or any activity or any milestone which has happened related to any leasing activity, be it as a lessor or a lessee, then you can write it. You can disclose the same under qualitative disclosure heading. There is no separate financial disclosure which is required according to me as per Ind AS 116.
Right. So there's one more question. What is the difference between the SAP and MAP? You had noted SAP and MAP. Is that somewhere?
Significant? Yes. I'll take this question, and very interesting questions and very important. See, last year only significant accounting policies were changed to material accounting policy information. Rajat, it is material accounting policy information. Previously, it used to be significant accounting policies. So you go and see Ind AS 1, write it down, para 117. So there was para 117 A to E. These were the paragraphs which were amended and introduced last year. It prescribes one primary condition. The primary condition is that the information which is there in which is assessed whether it is required to be presented or not, if it can influence along with the other information which is given in the notes or accounts the decision of users of financial statement, and it is material enough. So the primary condition is that only if your material accounting policy information, say for example, property, plant, and equipment. So it will tick the first primary condition in any case. Then there are 6 secondary conditions. Examples of few are if there is a specific disclosure which is required by the index, if the calculation which is required to be carried out is complex, if there are 2 indices which are applicable on a particular transaction or a particular statement which is required to be disclosed, if you are opting out of these 2 indices, if there is an accounting policy which is developed by your company, there is no specific guidance in other of the Indian accounting standards. So ऐसे करके there are 6 secondary conditions. So for an accounting policy information to be relevant enough or to be material enough, you need to prepare a proper materiality matrix for your record purposes also, for your auditor as well as for your audit committee, because in listed entities these things pass through the audit committee's approval only. So you need to prepare that materiality matrix. First you will check whether the primary condition is being passed or not. Then out of 6 secondary conditions, if any one of the secondary condition is passed, for example property, plant, and equipment, there is a specific disclosures which is required as per Ind AS 16 about the useful life, about the depreciation method, etc. Then it becomes a material accounting policy information. Then comes para 117E. You can write it down also. It clearly says there should not be any obscuring information. Obscuring information means that the information which is presumed to be in knowledge of the users of financial statement or which is not relevant enough. One such example, if you say de-recognition of any property, plant, and equipment, or de-recognition of any type of other financial assets, etc., it becomes obscuring because there is no other way which is given in Indian accounting standards or other standards a asset can be de-recognized. If there is any definition, for example, I am writing that an asset is capitalized only if the probability of future economic benefits and so on and so forth. So then these things, if you are reproducing any definition, these things becomes part of obscuring information. Obscuring information can be one of the most common examples is the accounting policy, material accounting policy related to financial instrument. Even if I don't have any debt instrument, etc., I am disclosing the policies related to equity instrument, the policies related to debt instrument level 1, 2, 3. It is one of the most monotonous accounting policies in most control F and control C and control F policies policy which is there. So it can be an example of obscuring information. If, for example, in case of property, plant, and equipment, I have seen in many cases people are writing that what treatment they did when they adopted Indian accounting standards for the first time. It is not relevant. So these are few of the example. Even if you talk about the accounting policy of cash and cash equivalents, I don't feel that it is material enough to be reported. It is not a material accounting policy information. So a proper materiality matrix is required to report, and it is very important, rather than all my fellow participants, from the perspective of the auditor also, because when I'm certifying, I'm signing the balance sheet, I am saying that it is true and correct, it is true and fair. I am assessing, I analyze all the particulars. But if the company is presenting, companies in default if they are not giving or they are not presenting material accounting policies in the right way, but the auditor is also under question. What has happened in the last year, I'll say, and you will be able to you see 5 balance sheets, कोई भी random 5 कंपनियां निकाल लीजिए mid cap या large cap, and you will see the change which has been done is the only heading of that particular section. SAP to MAP has been done, rest remains to be the same. Any other question, Rajat?
No, sir. Thank you so much. I think there's no more questions we have got. And this, thank you so much, Kuldeep sir, for
Thank you.
such a wonderful and insightful session on best financial and non-financial reporting practices. And as a chartered accountant, as an auditor, it is of vital importance for all of us to understand what's important. And even if big conglomerates and companies and auditors tend to make mistakes, we all can. So the best way to avoid is to empower ourselves with knowledge. Thank you so much, sir, for such a wonderful
Thank you.
session, first technical session. And with all the participants and on behalf of the CP committee, I extend you a very, very
Thank you.
warm thank you for this wonderful session. And with your permission, we move on to the next technical session for today.
It is with sir's permission that I've continued till 5:13. So it is my permission is not required. We, as a article also, we used to hear about. I lived in Jaipur, sir, till 2008. So one of my friend Varun used to work in your firm only, Varun Pandey. So it is a privilege to share the screen with you. So over to you, sir. Sorry for making you wait for 10-15 minutes more.
So let me introduce you everybody to our esteemed speaker, C. Ajay Kumar Atulia sir. C. Ajay sir has more than 28 years of experience in the areas of auditing and assurance services, internal audits, operational audits, management audits, GST, company law, information system audits, etc. He's also associated with IRDAI and has delivered lectures on bank and insurance audit at various instances. He has vast experience of bank audit and presently Central Statutory Auditor of Canara Bank. He has been Central Statutory Auditors for Life Insurance Corporation of India, General Insurance Corporation of India, and the New India Assurance Company Limited, Bank of Baroda, Union Bank of India, to name a few. He has extensive experience of dealing various assignments of banks, multinational companies, non-banking financial companies, telecom companies, insurance companies, electricity companies, and construction companies. Sir, with such a vast experience, we want your guidance on our second technical session, that is audit of advances. Over to you, sir.
Thank you, Rajat, for nice introduction. And I'm thankful with my elder brother and chairman CP committee, Satish Gupta ji, and vice chairman Vishnu Agrawal ji and CP committee for giving me this opportunity to share my thoughts on the bank audit. So now the screen is visible.
Let me.
That's fine.
Yes, sir, the screen's visible there.
I'm a bit from the screen. So friends, I have given the task to discuss the audit planning and audit of advances in a time of 45 to 50 minutes. So I will try to cover each and everything to the extent possible. And after this webinar also, I am available for discussions and through the mails or WhatsApp also. So friends, in the today's seminar, I have to cover the audit planning and audit. So before starting the planning of an entity, we have to understand what is the entity, what are the risks, what are the others. So friends, first of all, we understand that what is the business of bank. Banks are the business of trust. If you have the trust, then you bank with it. Otherwise, you will go for another bank. And money is the product. So when the trust is involved and money is involved, you know what is our responsibility. In the bank audit, we have to understand the risk, responsibility, which statute governs. First of all, I'm thankful to my previous receiver Kuldeep Bhai, who discussed with our risk and responsibility with respect to reporting.
Thank you, sir.
Yeah. So when we are talking about the bank audit, so we have to assess the responsibilities. There is a stakeholder expectations. Every type of stakeholder wants that auditors have done and examine each and everything. The prudential norms, the anti-money laundering norms, Basel to Basel III norms, then increase in certifications. Every day the certificates are increasing. In every year we find that 1 or 2 new certificates introduced by the Reserve Bank of India or other government of India. We have to certify as a bank auditor. Then digital banking. Now the banks are open 24/7 and we are getting the real-time credits in our accounts. You can imagine that how much the backend system is working for getting the real-time accounting, real-time credit in our accounts and debit in the accounts. Then auditing standards. Friends, our auditing standards are increase our responsibility, the reporting requirement, which is being narrated in the previous session also. Then our audit quality AQM, which is being prescribed by, and also the NAFRA and peer review. As the banks are listed entity, so NAFRA played its vital role in regulating and examining the audit reports, and our peer review board also making, which is being very well explained. Also, the risks are being explained by the Kuldeep also. You identify the risk, you name the risk. Every risk is associated with the bank. Maybe it's operational risk, credit risk, regulatory risk, legal risk, technology risk, reputational risk, money laundering risk, security risk, market risk, liquidity risk, interest rate risk, all type of risk, social media risk. If you envisage that what type of risk is available in the financial market, everything is associated with the banks. So after deciding the risk and responsibilities, we have to understand that banks are governed by which statute. So please note that the audit of the banks is governed by the Banking Regulation Act 1949. This is the main act which governs the audit along with the RBI as a regulator, and all the my balance sheets and as we draw in the Companies Act of Schedule 3, everything is drawn as per the Form A, Form B of the Banking Regulation Act. When you are doing the audit of the State Bank of India, then along with the Banking Regulation Act, there is a State Bank of India Act. If you are doing the other nationalized banks, so along with the Regulation Act, the Banking Companies Acquisition and Transfer of Undertaking Act, as nationalization happens 3 times, so 3 acts are there. And if you are auditing the private bank, then you have to go through the Companies Act also. And if you are doing the rural banks, the RRB acts also. So we must understand which type of regulations applies on the entity which we are auditing. Now, what type of work we are doing with the bank audit? So as a branch auditors, we have to certify the 3 things: a statutory audit, including the audit of IFC, the long form audit report, and the certificates. And we have to complete all these things in a one go, in a one visit to the branch. Now I'm taking this from the one of the RBI circular on LFAR, which says what is the objective of the bank audit, branch audit. So I'm just taking, you just please go through this. It's a very important thing. The overall objective of the branch audit should be to have transaction testing and provide inputs to the statutory central auditors on adequacy of implementation of various policies and regulatory requirements, including efficacy of the system and assurance function, risk management, compliance, and internal audit. So what I'm saying, apart from the certifying the true and fairness of the state of affairs, we have what the RBI regulator expects as an objective that we have to do the some certain transaction testings and give the inputs to the central auditors. Looking this backdrop, I'm saying the role of branch auditors are very important, as the branch auditors are central auditors are auditing only the 20 branches. Rest of the things are being audited by the branch auditors. So central auditors are heavily relied on the audit of the branch auditors, and even our fraternity and as when we are talking about that we are the auditor of the particular bank as either branch auditors or central auditors, so it carries lot of weightage and responsibility. So friends, looking this backdrop of our responsibility and risk and everything, and the timelines available for the completing the bank audit, and what is the expectation from our accounting standards and other stakeholders, auditing standards and other stakeholders, we have to plan the audit in a manner that we can complete the audit in the prescribed time effectively. So in next 5 to 10 minutes, we will discuss that how we plan ourselves for the conducting the audit in a timely manner. So friends, my planning starts as soon as I got the appointment letter. Please carefully read the appointment letter and examine the what are the terms and conditions related to the is mentioned in the appointment letter, and what are the duties and responsibilities as auditor, which is as per the Banking Regulation Act, is that everything is mentioned in the appointment letter. So please go through the appointment letter first. Then ensure that there is no disqualification for being appointed as auditor. Based on my experience, I told that there are certain cases where the audit firms have branch auditors have accepted the assignment, even they carry the certain disqualifications, and it becomes a big problem for them in the later on. So please ensure that your firm is not disqualified or remove the disqualification before accepting the assignment. Communication with the previous auditor. Please communicate with the previous auditor. It is the mandatory as per our code of ethics, and so please do it. Then audit engagement letter. Please issue the audit engagement letter. I'm taking the reference of guidance note in my presentation a lot of times because the guidance note is a very important document. If you go through the annexures of the guidance note, there is a format of engagement letter which is to be issued by the branch auditors and addressing it to the appointing authority. So whomsoever designated person have signed your appointment letter, please issue the engagement letter to him. Plan for by joining the seminars and webinars which you are doing. Then another planning aspects come. Please contact the branch well in advance. Although we are on the 4th, but still some persons have yet to start the audit. So examine the branch is the deposit oriented or advance oriented. What are the composition of advance? If possible, visit the branch. Read the Mitra committee, Ghost committee, Jilani committee recommendation, which is come along with your appointment letter also. So these complaints we have to check and report. And selection of team. Once you are aware about the composition of branch and advances of working of the branch, select the team, allocate the work to your team members, and define the work subset for each day. In my presentation, I will demonstrate in the 3 days how we cover the things. But it is necessary we have to plan from our office itself. Yes, in these 3-4 days, we have to this work, and this person will do this person will do this. Get the bank audit circulars handy in mail or phone or hard file. Please carry all this. Now the time of the IT, so make it a Google Drive or all the circulars in a one place. Carry the bank appointment letter and closing instructions. Then ICI guidance note, we will discuss in next slide. And mail the branches for the required documents. Since I'm talking about the ICI guidance note, this is the entire thing for the bank audit. Institute takes lot of pain in almost it required 5 to 6 months to complete to get the revised edition of bank audit. AASB put a lot of efforts as a special innovative AASB and part of the working study group of the bank audits. I can assure you that this is the comprehensive document which is available at the click of the button in the ICA website. And whatever the problem you face in your bank audit, you just identify these keywords and search in this guidance note. You will find the answer of each and everything. This guidance note contains two parts. Part A is for the central statutory auditors and part B for the branch statutory audit. So please give your team and all the partners this guidance note, which is available. Download it from the ICA website and refer it. In this guidance note, for the section for the branch auditors, in the section B, I'm just referring the 4 chapters. This is very important to learn. They contain only 40-45 pages, not more than 50 pages. All these 4 put together. Chapter 1, practical guide for statutory branch auditors performing branch audit for the first time. So, person who are doing the audit first time, what is step they have to understand? Bank branch audit planning. What is the planning required? Even my presentation is based on this chapter only. Overview of standard of auditings. What are the standard of auditing is required? What is to be ensured while completing the bank branch audit? And special consideration in CBS environment. As the entire banking is under the CBS environment, so these 4 topics, it will take hardly half an hour to read it. Please go through it. This will help you in the bank audit. Another part of planning is we have to understand and read the bank's guideline for closing and audit. Friends, all the banks have issued the closing instructions to their branches for the closing of the accounts. And branches supposed to meticulously follow these closing instructions. Please go through these closing instructions. This is the booklet which contains each and everything. What are the steps to be taken by the branch for the closure of accounts? What are the entries and year-end provisions to be passed by the branch? What are the entries and year-end provisions to be passed by the regional office and passed by the head office? Which account should be reconciled with general GL head, with GL head to be reconciled with which head? So everything is mentioned in this guidelines. It is a pure set of instruction. It is advisable to read this booklet and make a note of it. Then another important point is accounting policy of the bank. So, as we are all aware and we discussed in the first session also, the accounting policy, whatever the significant accounting policy, now material accounting policy is disclosed. Understanding of the accounting policy is important. And if we chartered accountant does not read the accounting policy, then what we can expect from other persons? In this accounting policy, as you have very well mentioning the which items are being accounted on the cash basis, say locker end, how the accrued interest is spread during how the commission is being accounted for. So everything is mentioned in the accounting policy. The closing guidelines and accounting policy and ICA guidance note. These 3 sets, if you refer for your query, you will get the answers. And for the one major problem, what I feel that there is a lack of communication between the auditors and bank branch. What happens? So please inform your time schedule, give him the list of requirements, and whatever the observation you observed during the course of audit, please communicate on daily basis with the branch head. Get the replies of each and every observations and use these replies as your written representation. Whatever you ask and whatever is being replied by the branch management, it is a part of your working paper. It is part of your written representation. And for the letter of requirement, please go through the ICA guidance note. In the appendix to this guidance note, there is an appendix which contains what is the format of the letter of requirement. And also there is one checklist for the branch overview. Please get both the information well before you start the audit. Now, friends, important thing is this RBI master circular and master direction. First of all, I want to discuss what are the master directions and what is the difference between master directions and master circulars. Since directions are regulations, is the rules. So these directions are meticulously to be followed, and once the direction is in place, all the entire circulars and all the entire earlier directions relating to that topic is being repealed, and that repeal chapter is already mentioned in the directions. Where is the master circular? Is the consolidation of circulars. So when you find when you refer the RBI notification and when you find the RBI directions and RBI master circular, when you refer the RBI master direction, please follow the whatever the latest directions available. If you refer the RBI master circular and there is if you are not clear about the interpretation, please go through the main circular. In the master circular, the list of the circular consolidated in that circular is also given. As we are majorly focused on the audit of advances, so master circular for the income recognition, asset classification and protection norms have been issued by the RBI on the 1st April 2025. Every year RBI issues the master circular. So please download the copy of this master circular, which is hosted on the RBI website on the 1st of April, and understand and carry the circular and refer the circular for all the IRAC norms. Another thing is access to the system. Please request the branch for giving you the user ID, view only user ID into the access of their system. Please note the banks are having the MIS data also and live server also. Please log in the live server only, because in the live server previous one day data is there. So as we are auditing as the 31st of the March and we are visiting in the first of week of April. So entire thing which is related is available in the system. Please ensure that user ID is available and you are doing the audit through this MIS server. Training to staff. The important thing is planning the materiality level. So we have to define, identify the materiality level for the each and every audit as per our auditing standards. When you get the instruction from the central statutory auditors, you will get that they have identified certain materiality level. Please don't increase that level. If they give the threshold 50,000, don't increase to 50,000 per 1 lakh. But looking to the nature of the size of your branch, operation in your branch, you have to, if you feel that 50,000, the threshold prescribed by the central auditors, I'm taking the example, is very high, you can reduce that level. So please assess whatever is suggested by the central statutory auditors, what should be the materiality level in accordance with our standard of auditing, and calculate this and apply the materiality level. Then these are certain auditing standards which we have to keep in mind while performing the branch audit. SQC1 quality control, which is important. Then SA 200 basic principle governing the audit. SA 210 agreeing the terms of audit engagement. 220 quality control. 230 audit documentation. SA 300 audit planning sampling. Knowledge of business. Risk assessment, internal control, audit evidences. All these are standard of auditing which we have to keep in mind and we have to adhere. We have to take our samples. We have to document our audit documentation as advised by these standard of auditings. Since I'm talking about the two important standard of auditings, SA 260 and SA 265. The SA 260 says auditor of any entity should communicate with the person those charged with the governance. Basically, it is the communication of the auditors with the audit committee. Practically. And each and every audit, when we are auditing when all of you are auditing the other listed entities or other large entities where you just definitely communicate with the audit committee. See, in the similar way, central auditors is communicating with the audit committee. But when you find there are certain areas of concern areas, there is certain observation which you feel it is have the larger impact on the bank level and it should be communicated. Although bank have the practices and we have identified it, even we have not considered the key audit matter also, but you feel that this is to be an area which is to be communicated with the person who charged with the governance. please do write a separate mail to the central statutory auditor of your circle or branch and mention that this is the area which is need to be communicated in compliance with the SA 260. Then SA 600, you definitely get the instruction from the central statutory auditors about the what is the expectation of the branch auditor by the central statutory auditors. So please go through that instruction of SA 600, and also our reporting. Please sign your report based on the assays, and especially all the banks are listed entity to use the new SS 701 for the key audit matter and identify the key audit area and report the key audit matters. You will find the certain key audit, standard key audit areas, and or maybe the based on the debt bank, some key audit matters being reported in the annual report of the balance sheet. Apart from this, if you feel there are certain areas which is required to be reported, please do report. Friends, for the planning of the audit and when we are doing the bank audit, apart from the statutory regulations and RBI guidelines, we must have the basic understanding of the other laws. So please advise your team members that they must have understanding of these laws, Indian Contract Act, because all the legal documentation and everything is which is executed by the bank, governed by the Indian Contract Act. The Negotiable Instrument Act, the FEMA, the Stamp Act, the SAFECIA, the IBC Code, DRT, all these are the other laws which we have to understand. I'm sure that you all are expert as qualified chartered accountants and you all are doing the practice in these areas. But please advise your articles also. Before drafting any observation, we should ensure that what is the compliance and non-compliance of these acts. Also, banks have the system to issue the major guidelines, policy guidelines, which is approved by their board. And all these guidelines are nowadays available in the bank's CBS system because they have the separate module of their circulars. I'm just referring certain guidelines. Maybe nomenclature is different in different banks. Some bank is taking is a loan policy. Some bank maybe is a credit policy. But there is a guideline how the loans to be sanctioned and disbursed. There is a guidelines how the collection is to be made, recovery to be made. There is a guidelines on documentation. There is a books of instructions, what is to be done. There are product profiles. Everything is available. So please refer these guidelines also when you have certain query. Now we have to understand the accounting and reporting software used by the banks. And we have to, now it is the days of the IT and AI and everything. So you will, first you understand that which software bank is using. In India, it's basically three softwares that in practice. One is the Finacle, another is the Banksys, and third is the FlexCube. Finacle from the Infosys, Banksys from the TCS, and FlexCube from the Oracle. So different banks are doing using different sectors. Please do little study and get the knowledge of the commands for these softwares. Lot of commands and lot of the commands used in these softwares are under circulation. Please get it. Another software used by the bank is the balance sheet preparation software. So, as we discussed, the balance sheet is drafted as per the Schedule 2 of the banking regulation at Part A, Part B. So, whatever the it is the generated from the Finacle or CBS, it is the day-end balances and regular books, and which is to be converted in the bank format of the banking regulation and by the another software. Then third software which is being used by the banks for the asset classification software. After the RBI circular from the 14 September 2020, we will discuss this little later. Now these CBS softwares have their inbuilt module of the asset classification. But still, there are certain private banks, large private banks, I don't want to name it, and some small finance banks and other banks also are using the software, asset classification software, which is different to their CBS software. So please check whether the asset classification done through the CBS system or it is being done by the another system. The RBI guidelines we will discuss later on, which says that there should be no manual intervention. Then another part is the reporting software. Nowadays, every reporting, maybe it's the main audit report or my FQFR report, LFAR or certificates, everything to be reported in a reporting software prepared by the bank, and it is to be digitally signed. So please ensure that what are the format and what is the, once you reach the branch, log in the software and download the reporting format, whether any Excel preparation, Excel files can be uploaded. So please draft your observations from day one in that format only. So it will be very easy for you to upload these observation files and complete the reporting well within time. Then another part is this communication with your central statutory auditors. As we discussed, the lot of informations are available. Apart from that, if you stuck up in any observations or any point, don't hesitate to discuss with the central statutory auditors, bank's finance department or audit department, who is the controlling the audit in this bank at either the head office or the general office, and issue the queries with the ICA expert panel. ICA, the expert panel also, even all the branches and all the regional councils have make the WhatsApp groups and for the expert panels. So please don't hesitate to ask with any expert. Now we are coming to the audit of advances. Friends, as discussed in the bank audit, the audit of advances is the important part. And even the RBI regulator also trusts that advances should be thoroughly audited and any impairment in the advances. Impairment means there is a, I'm talking with our language of the auditing standards, that there is no recovery or recovery not happens, and so all this we have to make the provision accordingly. So basically, when we are talking about the audit of advances, we have to go for the income recognition asset classification norms, IRAC norms. We already discussed that RBI came out with the master circular this year with the consolidation of the earlier circulars. Friends, these norms are introduced in 1992 by the RBI. In these 27th April 1992 is the first circular. Originally, the concept of 360 days, then it reduced to 270 days, 180 days, now it is to 90 days. So now everything is very streamlined and 90 days norms are applicable from last 12-15 years. In past 30 years, now everything is streamlined. I'm sharing my experience when we are doing the audit in 2000, 2004, 2005. The circulars come when at the end of the year or maybe the beginning of the year, and it's very difficult for bank to comply with all these guidelines. Now RBI will also make the streamlined. They issue the circulars well in advance, which is applicable for the subsequent dates. So everything is streamlined. Now the problem is this interpretation of these circulars and the implementation of these circulars. So now our auditor's role in the bank audit is to see how the circular is being interpreted by the head office, by the bank, or how it is being implemented by the branches. So sometimes implementation issue comes at the head office only, head office also, and there are a lot of implementation issue in the branches. So our role now after the automation is what is the interpretation and how it is being implemented. So now with reference to IRAC norm, the RBI came out with the biggest reform, and they came out from the circular of 14 September 2020 and give the ample time to banks that from the 1st July 21 onwards, asset classification should be the automated. This circular says automated IT-based system for asset classification, upgradation, and provisioning process. The entire process should be automated. It should cover all borrower accounts, including the temporary order, even including the debit balance in saving account, debit balance in current account. Everything should be the automated process. there are system-based preset rules. Now, what I'm saying, it is the rule-based. Asset classification is rule-based. What is the rule? What is the status of account based on the rule as of 31st? It has to be followed. I mean to say that sometimes their questions come, the subsequent recovery on 2nd April, 3rd April, 4th April shall be considered. RBI say no, it is the rule based. There is the rule on 30th, 31st, there is a default which is exceeding 90 days, account to be classified as NPA. If default, if the recoveries happens subsequent to this, now on that day separate rule will apply for the upgradation. Then this circular says system should handle both downgrade and upgrade, and it should be straight through process. There will be no manual intervention. So everything should be straight through process. And it is to be on daily basis. Each and every day end, bank have to classify the account, NPA, SME 0, SME 1, SME 2, depending upon the overdue, and mark the account accordingly. Although RBI says there are certain exceptions because everything is not possible to get the accounts for the preset rules for each and everything. So they say that there are certain exceptions, but these exceptions to be governed by, approved by the board of directors. Friends, after this automation, that is the old phrase of the IT is the garbage in, garbage out. Now, think is this, what is the feeded in the system, output will come accordingly. So now our role is to examine what is the feeded in the system. Friends, once the RBI came out with this guidelines that from the 1st July 21, every bank should identify the accounts on the automated process. There are a lot of challenges comes. So RBI came out with the master circular after the long time on the October 2021. Thereafter, RBI came out with the 2 circulars. Both the circulars are very important. Please download these circulars from the RBI website. Circular dated 12th November 21 and circular dated 15th Feb 2022. After a long gap, on the daily basis of, once the RBI mandated the daily basis of accounting, after a long gap, RBI came out with the detailed example, date-wise example. Once you go through the 12th November 21 circular, you will find that RBI given the example, what is the date of overdue or overrun, when it becomes the SMA 1, when it becomes SMA 2, and when it becomes SMA. This example categorically says that 90 days means 31st December's outstanding account will be NPA on the 29th of the March. So this is the clear-cut example. Please go through it and certain clarification also in both the circular. And now the master circular for 25. While we are covering the audit of advances, the next 3-4 slides, I have taken the verbatim from the RBI circular on the LFAR. What is the definition of advance and what is to be sampled to be covered in the advances? So what the RBI says, the answer to the following questions may be based on the auditor's examination of all large advances. All large advances. What is the all? For this purpose, large advances are those in respect of which the outstanding amount is in excess of 10% of outstanding aggregate balance of the fund-based and non-fund-based advances of the branch, or 10 crore, whichever is less. So if you are allotted the branch audit and where the advances is more than 10 crore rupees, they are categorized as the large advances. Further, you have to check what is the total exposure of the branch. Suppose total exposure of the branch is the 80 crore, out of which the 50 crore is fund-based, 30 crore is non-fund-based. So all these put together, 50 plus 30, 80 crore, 10% is 8 crore. Now, in that case, the threshold for the large advance is 8 crore and above. So 10 crore and above, 100% is there. And then calculate the threshold and identify the threshold, and whatever the above the threshold, we have to take everything. Now, this is a very important para in the circular of the LFAR. Politely, RBI warned us. They started with the care. I'm every time telling it is not a care, it is the warning. It is the warning to the auditors. What the RBI says, for all accounts above the threshold, the transaction audit account specific details to be seen and commented. So whatever the threshold we decided 10 crore and above and our other threshold, above the threshold account, specific detail to be seen and commented. Whereas below the threshold, the process needs to be checked and commented upon. So we have to, when we are doing the audit of the advances, we have to understand that in which account, what type of transaction to be seen. Comments of the branch auditors on the advances with significant adverse features which might need the attention of the management station auditor should be applied to the letter. So what the RBI says, above the threshold accounts has to be examined and commented upon with respect to transaction testing of these accounts. Then it says the critical comment based on the review on the above and other test checks should be given in the respective paragraph LFA. Then RBI says whatever you identified as a large advances or whatever taken as a sample, please give the details of each and every individual account in this format. What is the account number, account name, what is the year-end balance, funded, non-funded total. Then how much accounts we have selected as a sample. Then what is the total outstanding in the branch and what is the percentage examined. So please go through the audit, our sampling standard for the auditing of the sampling and ensure that looking the size of your branch, how much coverage you are required to have, and please make adequate coverage because this reflects what we have covered and now it is documented. So please try to cover adequately. Now questions come. Friends, I am not discussing the IRAC norm word by word because I am just discussing the how to select the advances, how we select the universe and how we report these things. Now the RBI says threshold limit is there. We have to do the testing also. So how to select the sample? If your branch is having 200 accounts, on what basis we select the sample of the 20 account, 30 account, 25 account? Again, I am referring the Institute Guidance Note, the page 554 of the 2025 edition. Basis of selection of accounts. The illustrative list is given by the Institute for the 30 critical criteria. Yes, you can select the advances based on these 30 criteria for your sample. Based on this and based on my experience, please obtain the, for the selection of the advances, obtain the CCOD and loan balance file, day and file, just what we are talking. Now it is available after the closing of the 31st March on the 1st of the April. Every branch has generated their balance book. Maybe nomenclature is different. The balance report, balance book, which contains the details of each and every account, security sale, sanction limit, outstanding, everything is there. Get this file from the bank. Calculate the threshold limit. And after calculating the threshold limit, select the sample, whatever the above the threshold limit, which is mandatorily to be covered. Obtain the list of stress account SMA1, SMA2, and identify the accounts which are under the SMA2 at the verge of the, which is more than 75 days under SMA2, not completing 90 days, but 75, 80, 85 days. What are the restructured accounts? One-time restructuring happens in the branch. Quick mortality cases. The quick mortality cases are those cases which are turned to the NPA within 12 months of their sanction. So all these accounts which are converted to the NPA within 12 months of the sanction should be part of our sample. Then red flag accounts. Since RBI came out with the early warning signal concept and they have mandated banks to implement the early warning signals and they have laid down certain criteria and RBI laid down 45, 50 criteria and advised banks to develop their own criteria. So nowadays, each and every bank is having their own 70, 75 criteria, which gives the alert or early warning signal. Based on these early warning signals, bank have the process of internal rating of the red flags and identify the accounts as a red flag where the concerns are there. So friends, whatever the red flag accounts in your branch should be the part of your sample, because bank has already identified them as a red flag, and it means they have certain concerns in these accounts. And just to explain further, once the account is being marked as red flag, bank have to investigate it, and within 6 months, either to remove it as the red flag tag or classify the account as a fraud account. Then take the sample of top 20 NPA accounts. List of advances where adverse issues have been noted during the previous audit reports. The previous audit report, you find the certain accounts where the adverse reports are there. Take these accounts in your sample. Accounts upgraded during the year or previous year. Open the list of upgraded accounts. Which are the accounts which is the either in the previous quarter or previous month or previous days being downgraded and then again upgraded. So take this sample, these accounts in your sample. The accounts where rating has been downgraded. So take these accounts here. Standard advances in litigation. Account is standard, everything is performing well, but there is certain litigation either by the borrower or maybe the bank, by the bank or some or any other thing. So if it's any accounts under litigation and other adversely commented accounts, LGBG default and invoke accounts where accounts where the letter of credit or bank guarantee have been revoked. Cases where decrease has been awarded by the DRT or maybe the other appropriate forum, and what is the status of their execution. List of IBC mandate accounts where initiation of corporate insolvency process has been mandated, and the list of fraud detected and reported by the branch. So based on these criteria, still 3-4 criteria are there. List of corporate accounts where the buyback happened, accounts with ECGC and CGTMSE cover, what are the method of the renewal, policy of external credit rating. So based on all these criteria, please identify the critical accounts. We have to take the large advances. Now, sometimes this questions comes, so 100 crore branches there. So threshold comes to 10 crore, but all the exposure to the is not exceeding the 10 crores, or maybe the threshold comes to 8 crore, but there is no single borrower who exceeds the 8 crore rupees. What is to be done? Friends, in the LFR RBI says we have to comment on the top 5 standard accounts. So I am saying take the top 5 standard accounts in that situation, and also the which type of accounts are there in the bank. If it's a lot of term loans, housing loans are there. So in each and every segment, select 2 or 3 top accounts in your sample. Once we select the sample, now we have to understand how we get the information for these accounts, which we have to use in reporting it, which we have to analyze. So, friends, in case of all large advances above the threshold, RBI mandated that branch have to prepare a status note, which is the forming part of the LFR itself. This status note has to be prepared by the branch well before our arrivals. It is my experience that branches are not keep this thing ready. Please ensure that branch should ready these status note, because it is the handy information of these accounts. Also, the one key fact statement introduced by the RBI from the 1st October 24 onwards. So this key fact statement and the status note, the LFR of each and every sample you have identified, give you the brief idea about that. Go through the reports of the previous year's audit reports and LFR. Is there any comment relating to your identified samples? Concurrent audit report, internal inspection report, RBI inspection report, then credit audit report, stock audit report of the borrowers, and also ensure the compliance of all these reports. So, whatever the critical observations mentioned in these reports regarding the advances, please take these advances in your sample. Another thing is exception report. Each and every bank after the implementers Finacle have the process that whatever the transaction being executed, although with the prior approval or with the permissions, but which is not the normal transactions, or maybe the beyond the delegated authorities. So these exceptional reports are after the end is circulated to each and every branch head, and branch head to ensure that in case of all these exceptional transactions, everything is being done timely. So please go through the exception reports. Then list of probable NPA, the list of SMA classifications, and NPA list. You will find the advances. Also, you will check the MIS from the CBS, which gives you input about the account. From this, once again, I am telling you, there will be different nomenclature, but each and every bank have the system of MIS. MIS reports are available. Even you will get the when your closing instructions set of list of MIS report, which is useful while conducting audit is there. Please download all these reports. These are the interest flag report, pending insurance report, limit expiry report, overdue report. Rajat ji, time hai na?
Sir, we are getting questions from the participants. So
let me complete within 10 minutes, 5 to 7 minutes, then we'll take the questions.
sure, sir, sure.
Critical issues are there, so that we will report. So I'm talking about the examination. So there are two types of examination. One is the classification for the IRAC norms, as well as the classification sector-wise and security-wise, secured and unsecured. So one approach is this, and second set of the examination is the procedure and documentation. So when I'm talking about the classification, it is based on the IRAC norms, and as we discussed earlier, IRAC norm is automated. So things are, the principle is this: if the garbage in, then garbage out. So we have to examine, especially the sanction note of the competent authority or the branch, whether the sanction note has been fully complied and fed in the system. If all the terms and conditions have been correctly fed in the system, now the output will be as per the IRAC norm, because that is being tested by the central auditors also and all the RBI regulators also and bank itself also. But what we observed that there are the information in the file and information in the sanction letter and what is feeded in the CBS have the variances. So please go through it. I'm just narrating the critical things: value of security, review date, repayment schedule, first and installment date. If the schedule is feeded wrongly, the output will be wrong. Sanction limit, if there is change in sanction limit, not updated, continuous access date, resettlement date, review date. All these things are being feeded by the branch manually. So nowadays, the audit is to identify the user level errors. Now I'm talking about IRAC norm certain key issues. Friends, I'm talking about this criteria. That is the only criteria in the IRAC norms. Otherwise, IRAC norms say it is the rule-based IRAC norms. They say here is the auditors have the authority to classify the account as NPA on the deeming fiction. Accounts regularized near about the balance sheet date. If you go through the RBI Master Circular in the fourth clauses, I will share the exact number also. There is one clause is accounts regularized nearby, and it is categorically mentioned in this clause where the accounts will be regularized nearby the balance sheet date. Now or at the day end process on the 89th day or 87th day, every credit should be examined and it should not be subject of scope of subjectivity. Genuine credit has to be there. It's bank's responsibility to convince the statutory auditors that credits are genuine. Otherwise, based on the inert weaknesses, account can be classified as NPA, deemed as NPA. The word is used as deemed as NPA. Another thing is appropriation of recovery. The RBI says now appropriation recovery is based on the each and every bank have to develop their accounting policy. Please go through the accounting policy and follow that appropriation has been done as per that accounting policy. Advance under consortiums, RBI says now each and every bank should be classified as account of NPA as per record of recovery in their books. If account in the leader book is standard, but in my book, 3 installments are pending, account to be classified as NPA, irrespective of in the leader book, it is standard. Accounts with temporary deficiency, we will discuss later. And advance again, term deposit, NSC and KVP. Only all these 3 things, RBI says IRAC norm should not apply in these things. If it is bank's own deposit, it is the NSC KVP. RBI only says if the realizable value of the term deposit means realizable value principal plus accrued interest, or NSC realizable value is not enough to cover the outstanding, then account triggered as the NPA out of order and 90 days NPA. Asset classification to be borrower wise, not the facility wise. Suppose if I am having the 4 accounts, education loan, personal loan, housing loan, vehicle loan, I am defaulted in the paying the installment of the personal loan, and account is classified as NPA. So my entire 4 accounts are to be classified as it. Which is the borrower wise, not the facility wise. And also the RBI came out and explained that in case of co-borrower, if the co-borrower account is classified as NPA, co-borrower's individual account should be classified as NPA. Then accounts where erosion in the value of security. First of all, we have to understand that erosion in the value of security came into the picture when account get triggered as NPA. RBI this master circular says when the account becomes NPA and security is eroded and securities value of security is less than the 50% of the outstanding, but more than the 10% outstanding, it is to be straight away classified as doubtful assets, and the value of security is less than the 10% of the outstanding balance, it is to be classified as loss assets. Another important point is we have to understand and check that now the banks have the system of the SMA 0, SMA 1, 30 days, 60 days, then 90 days. Is there any account classified as NPA during the year without putting in the SMA process? Then there is it can be happen in case of fraud accounts. Other than fraud accounts, everything should be routed through the, if accounts is not routed to the SMA system and straight away classified as NPA, then there is some challenge in the asset classification software. So please identify this account, do the root cause analysis if you find such type of account. Another important term is upgradation of NPA. Now RBI says if one account is NPA, one facility is NPA, entire account of that borrower becomes NPA. Now for the upgradation, we have RBI categorically says we have to ensure that overdue in all the borrower, all the accounts of the borrower should be realized. Just for example, when we are in our earlier example, housing, my personal loan has the 3 installments overdue and account triggered as NPA, but personal loan has only 2 installments overdue, housing loan has no overdue, whereas the education loan has 2 installment overdue. So while completing upgrading, entire thing to be covered. Entire, if I paid only the 3 installments of the personal loan, which is the NPA, and not paid the arrears in the 2 installment arrears in the education loan and 2 installment arrears in the vehicle loan, my account cannot be upgraded. Once I make the 0 overdue in all the accounts, then only it will be upgraded. Then certain issue we find in the CBS system that's it is usual because these authorities are given to the branch managers for the smooth functioning. So sometimes what happens, undue removal of NPA flags. The branch manager have authority to remove the NPA flag if everything is being paid on. But there may be some undue removal is there. Interest charge in NPA accounts. Sometimes we happen the interest income has been booked in the NPA accounts due to certain bugs in the system. Interest reversal considered as recovery. There are system entries of same account debit credit to avoid the becomes the NPA, to avoid the accounts classified as NPA. So these type of accounts, once you identify the accounts which are under the to examine all these things, I give simple methodology. Obtain the list of SMA2 on the 28th February and SMA2 on the 31st March. If the account is the 28th February under SMA2 and still not classified as NPA after the passing of 30 days of the March, it means certain recovery has come. So compare these accounts, identify these accounts to check whether recoveries come from genuine sources or whether any certain type of things are there. And then use your power and the deeming fiction of NPA. Since we are talking this as the for the rule-based asset classification record of recovery, there are certain examples where account is running perfectly, no overdue, nothing is there, but it is to be classified as NPA. There are 4 or 5 criteria. RBI says if the stock statements are not submitted, within, if the 90 days of the earlier submission date, the account is classified as NPA. For example, the last stock statement, stock position of the 30th September is available in the system. So RBI says from the 30th September, you next 90 days, you can allow the regular DP. From the 91st days, for example, it becomes the 1st January, DP is irregular and another 90 days account to be classified as NPA. You will find that these dates are not capturing in the proper in the system, or maybe the dates are taking, different dates are taking. RBI categorically says stock position date should be considered for counting the regular DP 90 days and another 90 days for the order. Then non-achievement of DCCU. In case of large projects, RBI says this is the practice, this is the mandate by the RBI. Once you appraise the large project, there is a financial closure, and it has been decided at the time of the finance closure that this is the date of commencement of commercial operations. Is there any RBI permit the extensions? So please ensure the extension is as per the RBI guidelines within the specified periods and within the delegated authorities. Otherwise, account to be classified as NPA if not achieve the DCCU. Similar way, in the restructuring, there are a lot of terms and conditions stipulated when the account get restructured. If the restructuring conditions are not complied, for example, there is one condition in the restructuring that promoter have to contribute this much of additional capital. They have not contributed this much of additional capital. Then it is the failure to comply with the key condition of restructuring, and these accounts to be classified as NPA and restored back to their earlier classification. Erosion value security we discussed. Delay in review renewal. Similar way, if there is a delay in review renewal for more than 180 days, account to be classified as NPA. Then 2 more slides with the important slides. Then we will take the question answers. Friends, agriculture advances. So agriculture advances, the term is very large. I take the 2 minutes to, there are 2 RBI circulars. One circular is the master directions on priority sector lending. And then 2025 directions came in the 24th of March. It is available in the RBI website also. In this direction, their clause number 9, they have identified that these are the agriculture advances. So there are very large definition of the agriculture advances. All these advances are to be classified as agriculture advances for the priority sector classification. When we came to the IRAC norms for the agriculture advances, please go through the Annex 2 of the Master Circular, and para 4.12 is there in the Master Circular, which categorically says the advances which pertains to the farm activity, i.e. cultivation of farms or development of farms, which is related to crop. These are the farm credits, and only the farm credit is to be considered for the crop season norms. All other agriculture advances to be classified based on the 90 days norms. So please don't take that it is the agriculture advances, so everything is the 2 crop season based norms, only on the farm credit. And I assure you that at the head office level, because based on my experience, this is being implemented properly, and separate codes are given, product codes are given for the farm credit and non-farm credit. But what happens? Users are opening the accounts in the wrong way. So we have to understand that, for example, if I construct a warehouse for storing my own crop on my land, it is the farm credit, agriculture credit. But when I construct a warehouse for storage of the other person's crop and take it on the rent, then it is the commercial activity 90 days. So basically, loan is the purpose of construction of warehouse to keep the agriculture produce. But if it is the farm credit, only when it is used for the own crop. So sometimes what happens, loan is given for the general purposes, for the letting out this warehouse, and account is open in the farm credit sector. So these type of ensure that proper codes have you. And another important point in the agriculture loan is the valuation of standing crops. In the NPA accounts, banks have the practice to take the value of the standing crop as a value of security. Please ensure that there should be proper basis. Otherwise, it is to be not to be taken as NPA as the value of security. Then two important points is this are in the gold loans. There are a lot of questions are coming with reference to gold loans. Please go through the RBI advisory of the 30th September 2024, where the RBI specifically pointed out based on their inspection of the banks that these are the common mistakes carried by the banks. RBI gives in the examples in the annexure that these are the mistakes which is not being adhered by the banks. Please ensure that if you find these type of mistakes, this account is treat the account as irregular. If it is a 90 days irregularity is there, classify them as N. Especially the breach of LTV. But now, fortunately, in this year, rates are keep on increasing. So breach of LTV cases may be not there. And further, the gold OD. Now, bank have to avoid the bullet repayments. Bank have introduced the new product, gold OD, for the 36-month period. If you go through the RBI master circular on the asset classification, when the definition of out of order is given in the para 2, there is a one more para which categorically says the concept of out of order is applicable to each and every type of overdraft. So when it is the gold OD, and account is out of order for the 90 days, either it is the exceeding the LTV, eligible limit or sanction limit, or continuously running order for more than 90 days in the sanction limit, account has to be classified as NPA. So, which is very clear by the RBI that out of order concept is applicable in each and every type of overdraft. Then education loan, please, this is sensitive sector. RBI came out that in white paper, the 14%, more than 14% is the NPA in the banking sector under the education loan portfolio in the entire banking industry. So this is the sensitive account. Please, and because the IBA model of the education loan prescribed that restructuring is possible due to certain reasons. But what we observed that restructuring is being done by the branches, which is not permissible, but they have done the restructuring. So please go through it. And personal loan and mudra loan. Then I will ask the committee to share the PPT. I have subset the 3/4 how we execute the audit in 3 days. What is to be done by the chartered accountant on day 1? This 7-8 area, what is to be done by the chartered accountant on day 2? And what is to be done by the articles on day 1 and day 2? And day 3, if you do all these things, you will cover entire working of the branch and you will use this. And last point is this, please discuss your observation with the branch heads. Don't keep any issue open. Important point, prepare your audit file at the branch itself. Document all the audit evidences. Once you sign the reports and left the branch, it's very difficult to collect the information later on. So please ensure that your audit file shall be completed. Thank you very much for your hearing. This is my number. I'm available anytime. Please feel free to call on any issue. Thank you very much.
Sir, thank you so much. We have few questions that have come up. I'm going through one by one. Some branches of the concerned bank are not giving signed management representation letter. What can we do regarding this?
That's why I said please communicate with the branch and ask each and everything in writing. What is the management representation letter? We are asking all the container liabilities have been provided for, all the expenses has been recorded. So you just ask everything in the query and take the reply. Let's ask him, is there any fraud is detected during the year? Let him say no. Keep this as a management representations that I covered already. Just please communicate with the branch, ask the information required, take the reply, use this reply as a management representation.
Right, sir. Another question that has come up is bank has not provided loan balance file data on email to us and given in writing that due to sensitivity of data we cannot provide on email. Bank is providing the same on its own computer only. How should we proceed in this situation?
Yeah, that's why I'm saying, because all are the listed entities, price sensitive information are there. So it is the SEBI stipulation also, the PIT regulations is applicable. So yes, there is challenges in giving the data outside the bank or branch premises. But you can ask him to hide the certain information and give us the name, because you can tell them we have already signed the fidelity and secrecy while accepting the account. We have given the declaration. We have signed the fidelity and secrecy affidavit, and we have given the declaration to the bank that whatever came to our notice and knowledge, it is to keep secret, not to be, and ensure that this is not to be given in the public. If you discuss with them, you will get the, you otherwise you will get discuss with the zonal coordinator, you will get it.
Right, sir. Sir, one more question. NFRA revised the SA 600, but our ICI has not approved it to date. So does it impact my bank audit reporting?
No. You see, there is a, everybody knows that ICI stand is very different, and it's very strong difference because the standard setting authority is lying with the ICI. That is the company that says. But if you go through the, and now whatever the as on date, NAFRA came with the draft only.
Right, sir.
What is the notified in the Companies Act? It is the SA 600 published by the ICI. As on date, that is only applicable. We have to follow. We are following this from the last 3-4 years. The same thing we are following for this year also.
Yes, sir. One more question. Last question is, sir, should LTV be checked at every change in the price of gold?
Yes, in the banks, there is a separate LTV tracker table is there, where in the every morning from the last feeded balance, because gold rate is being feeded by the centralized at the head office level. Based on that gold rate in the CPA system, everything is captured. How much of the gold is there? What is the rate is there? So LTV is being calculated on daily basis, and that report is available.
Okay.
And there is one report, LTV breach report is also there in the banks, where and after this RBI circular of the 30th September, banks have implemented the compliance of, and informations are available.
Right, sir. Sir, that sums up all the questions that we have received. Some of them are repetitive, so I'm not calling them again. And this was a very, very wonderful session. The planning for bank audit branches, starting from day one to end of the audit, and what all things to be checked about, you have taken up in particularly in very detail. You have taken up how to filter out, how to select the sample data, what should all be included, what norms and circulars and RBI directions to be followed. And this was a very, very informative sessions, and there was a lot of participants coming in from across India, from Jaipur, Chennai, Prayagraj, Mumbai, Ankleshwar, Kolkata, and everywhere people have been calling out some queries. That means the session was a lot of value, and we thank you so much, Ajay sir, for your wonderful time and your deliberation and the PPT and the guidance that you have delivered in the last 1 hour to all of us. On behalf of ICAI, the CPE committee, and all the participants, we thank you so much for this.
Just to mention the participants, if they have the certain query and which is not taken up due to paucity of time, they can mail it to me directly. I will try to respond.
Sure, sir, sure. This is an important information to all the participants standing out here. So if you could just present that slide for your contact details, maybe. So you can take a screenshot of it, although all the PPTs will be available to all the registered participants. So by the ICI CPE committee. In case you want to reach out personally, you can take that screenshot. So the other one, yeah. Yeah, you can take a screenshot of it quickly. I'm taking myself, and maybe this might help us. And all of us will be going or on the bank audits in this week and the upcoming week. So in case you have any query, do leave those serious queries only here. And thank you so much. Thank you for being such a wonderful audience as well. And thank you, Ajay sir. Thank you, CP committee, and thank you all the delegates for making this session wonderful.
Thank you, everybody.